Are you stressed out not knowing where to find distressed, off-market, high cash flow properties in high-growth areas? What about the best strategy to build a wealth-generating portfolio? Look no further. Dragan Domovsky of Buyers Agency Australia can help. With over 20 years of experience as a property investor, Dragan is a qualified property investment advisor and expert buyer's agent, so he knows how to find the best deals and negotiate for his clients. Right now, he's offering a free 45-minute strategy session to get you started, normally worth $500. Text the code BAA along with your name and email address to 0405 105074. That's 0405 105074. And take advantage of this offer. Take control of your financial future today.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hi, good everyone. How you going? Phil Tarrant here. I'm the host of the Smart Property Investment Show. Hope you're enjoying our commentary, our coverage of all things property and property investment. It's going to be one of those years. They always say it every year. Well, what's going to happen in 2024? It now appears that interest rates may start come down sooner than what was originally anticipated based on some inflation numbers that are coming out, getting into the target range where the Reserve Bank of Australia is happy. We all know that the board has changed at the Reserve Bank of Australia, how they do these things, and their meetings have changed. So there's less chances for the RBA to get together to raise rates. There's also less chances moving forward for them to cut rates. But this will be a big part of the commentary from economists over 2024. What happens and if and when rate cuts start happening from the Reserve Bank of Australia, how quickly the lenders will pass them on. So get set for a lot of fun and skullduggery and all this sort of stuff when that starts taking place. However, you shouldn't be sitting around formulating your finances on the off chance or the chance that rates may start coming down. You should be very proactive and take control of those things that you can take control of. And that's around repayments, so how you structure your debt, how you finance, what you finance, who you finance with, and how you get that finance. Every couple of times a month, I get together with the team from Finni Mortgages to chat about all these things. Joining me back in the studio, Eva Loisance is their senior broker there. She heads up broker operations. She knows what's going on. She's the person I talk to when I need to know what's happening, or if I've got a whinge or complain about something, which seems to happen a lot these days. Eva, how you going?
Yeah, good. How are you? That's good.
I'm
like
okay.
your complaints, that's fine.
Well, I was complaining. I've got this bee in my bonnet right now around trust investing and bank intransigence to reprice property investors with loans inside a trust. That's what maybe I'm wrong. There doesn't seem to be too many banks wanting to talk about it, even though I've had a number of different people speak to brokers and they're all saying the same things, that this is taking place. Eva, tell me what's going on. Is it really happening? Are banks not repricing inside of trusts? They're trying to, I'm going to call it the trust prison. They're going to keep people locked up, which worries me when rates start coming down, whether or not people are going to be penalised because they're investing inside of trusts.
Yeah, it is getting a bit harder to get good pricing within trust. And I guess traditionally it is harder to get a loan within a trust. There's less discount and pricing and the fees are a bit higher. It was okay in the last few years, but we've seen new or lenders that were okay with them and just not repricing. So whatever rate you've got, that's it. But hopefully there are more lenders also coming on board with trust lending, just like happened with SMSF, and hopefully the competition will come again.
So it is a thing. It's just not me imagining it.
No, it's not you, unfortunately.
No. Okay. All right. That's good. This is my job to sort of talk about these things. And what I'm telegraphing is where you'll start to see, you'll see pockets of innovation start to happen again inside of mortgages when interest rates starts coming down. So maybe this is an area where the second-tier lenders, the non-banks will start playing around. But look, that's just what are you going to do? But if you do have loans inside a trust, I'd be thinking about this as you sort of plan your financing moving forward. And to be fair, it's the differentials aren't as that much inside and outside of trust. You do pay a bit of a premium. That said, for a lot of borrowers, and we've spoken about this before, and property investors, Eva, typically they move into a trust type structure once they've hit serviceability restraints investing in their personal name. So it's a cost of doing business. If you want to keep advancing your property portfolio, that you need to start thinking about more sophisticated constructs
Structures,
for holding your property. So this is the way it is. But keep across it, be aware, speak to your broker. The team over at Finni always happy to speak. I love plugging you guys.
That's good. We're happy to share the trade secrets and what's going on. So that's
good. Hey, last time we got together, we had a really good chat, and we just organically ended up having a good discussion around some of the tactics to manage your repayments and minimize your repayments or pay down your debt towards giving you choice for retirement. And a lot of people are going, hey, that sounds really good. Could you do more on it? We said we would. So today, Eva, I wanted to get into this sort of, and it's a bit counter-cyclical for a lot of investors, because as we were just chatting about, they're all configuring themselves so they can keep borrowing money so they can keep building their portfolio before they get to a point where they're going to start thinking about repaying it. So, for us to do, or paying down the debt, for us to do a podcast around how to be mortgage-free quicker, it's maybe a bit counter-cyclical for a lot of people. However, there is a connection for property investors in this. And what specifically we're talking about is paying down tactics to pay down your owner-occupier debt as quickly as possible to be interest-free. And most people in retirement want to be unencumbered of a mortgage on their principal place of residence, i.e. It's not costing them anything to live every single month. So getting started on this sooner, and most financial advisors and even brokers will say, keep a P&I loan. It's not advice. It's just, sort of standard sort of commentary around it. Keep P&I loans against your principal place of residence unless you're distressed or otherwise, with view towards paying down that debt as quickly as you can. You cannot claim, Eva, any tax rebates against the debt on your owner-occupied loan. That is a fact, correct?
Correct, unless it is a split set up for investment purpose. So you can have a loan against your home that is for an investment property, and in which case it would be tax deductible. But if the loan is literally or was to buy your home, then no. So that's bad debt, I guess, as you want to call it. And this one, you can try to pay it off as quick as possible.
So pay it off as quick as possible. It's good. It's also, you don't get any tax benefits from it. And you got to remember also, you may not be getting tax benefits from a loan inside of your principal place of residence or your owner-occupier loan. So that changes your investment framework. However, a lot of people create wealth through property by transacting their principal place of residence with view towards moving properties and not having any capital gains tax implications connected with it. So that's another strategy that a lot of people do. And a lot of people also do, it gets complicated, is that there's a rule for when you move out of a principal place of residence that you are exempt from paying land tax for a period of time if you move back into it in the future. And during that period of time when it is invested, the tax complications around capital gains tax is different as well. So we need an accountant to have a chat with us in this. We're here to talk about how do you actually pay your principal place of residence off faster, your own occupied loan, and we'll get into that. And another sort of view towards this is if you are paying off your principal place of residence quicker, that means you have more equity in that property. So if you are looking to capitalize on that equity to use it to invest in property sooner, that's another really good way and a reason why to be doing this. So let's get stuck into this, Eva. We'll just go to a quick break. Stay with us, everyone. Back in a moment. Welcome back. Phil Tarrant from Smart Property Investment, having a chat with Eva. She's the head broker over at Finni Mortgages, finni.com.au. Now, Eva, paying off your mortgage quicker for owner-occupiers. Most property investors have a principal place of residence. Some are rent investors where they don't have a principal place of residence. What's the best way to do it? Probably starting earlier means you're probably going to get your loan paid off quicker, I would imagine.
Yeah, I guess that's the one to start. I feel like there's a lot of people coming to see us as I guess first-time buyers, and people get stuck with the idea of I need 20% to get started. So the longer you wait, because it can take time, especially in Sydney, to get 20%, in savings to get started. And by the time you might get this, the property market has gone up quicker than you can save. So you might need to save another 100K, but then when you finally get there, the property might be another 150 or 200. So you're working against yourself. So I think what I want to say here is that really people need to get in as soon as they can. There is enough schemes and grant now that you can get in with as little as 5%, really. And I think that's achievable by anyone, really, especially if you are in your 20s and on average Australian income, that's actually doable. It's impossible though if you want to wait for 20% deposit, it would take you 10, 15 years and then the market is just completely out of control. So yeah, getting in quicker, obviously the loan are generally for 30 years. So if you get in at obviously 25, 30 years later, you'd be debt free and can retire without a mortgage on your home.
It sounds so simple, doesn't it? Like
it is simple.
So the point is, the sooner you start, the sooner you can, and that's assuming a really linear traditional view of things, right? Saying that you buy a house at 25, by 55, you're mortgage free, right? And you've done nothing else. You haven't bought investment property. So it's very linear. And I doubt.
Yeah, but most people still, even if
most people do that,
simple
right?
and the idea, yeah, but
most people do that.
Yeah, I can still hear a lot of people thinking they need the 20%. Otherwise, it's not going to happen. But they are working against themselves by doing that. They could have probably bought something before COVID and have already equity in the place. So.
And this is the impact of leverage. So the point is start earlier. And I imagine people tuning this podcast are looking to invest in property. They might be young and new and buying a principal-based residence. Really good place to start, by the way. Sooner you start, principal-based residence, work hard, pay your loan off as quickly as possible. In 5 years' time, you've got what you've paid down plus the equity increase in the property. You start thinking about investing in property. Really, really smart thing to do. Quite simple, tried and tested strategy and relatively risk-free if you're buying in the right places, your principal residence for the value uplift, and also then you move into property. But the key point is, and I think a lot of this, it is a traditional way of viewing things. However, I think there's a traditional way of viewing things and this sort of expectation of the right for all Australians to be able to own their own home, which historically is the way it's been. So if you speak to your parents or your grandparents, they're going to probably tell you that you need 20% deposit. Yep. And there is a lot of misinformation around this. That's different. The disinformation is deliberate sort of false information. Misinformation is where people just assume something and just keep spreading it, right? So you do not need 20% in order to get started in real estate in Australia. What you do need, though, is a steady, stable job. What you do need, though, is an ability to prove that you can budget and save money. What you do need, though, is responsibility and reliance on yourself to be able to make mortgage repayments. And there's so many incentives around it, as Eva mentioned, government-based incentives, but also lending incentives, lending structures that allow people to borrow, inverted commas, from the bank of mum and dad to get started. And I can't remember, but I read it the other day, the amount of first home buyers who are using or leveraging the equity or the capabilities of their parents is just exploding at the moment, isn't it?
Yeah. That's the typical family pledge. And that's great. You can actually start buying a home with zero. You don't need anything. Zero in the bank account. That's fine. As long as you've had the job for 6 months. And as you said, you can service the debt. Your parents have a property with equity. We can actually do it. So there's no need to wait years on end to have 20% because you think lenders' mortgage insurance is a rip-off.
The issue is this trodden path of in the media of like, it's impossible for an Australian to buy a property these days. It's so hard. It's impossible to save a deposit. It's impossible to save a deposit in order to get a home loan. And the sort of great Australian dream of home ownership is beyond everyone's reach. That's their mistruths, those things.
Look, I guess most people that have actually a job would be able to do something. So, it might not be where they live and buy a $2 million house, but it could be that it's an investment property in Perth for $350, but at least they get into something. So I think it is possible for everybody to get something. And if it's not just yet, at least we can give them an indication of, okay, once you reach this, so once you earn that, then we can make it work for you.
So part of this is a mindset thing and an education thing. The other point is maybe rethinking perceptions towards LMI, which is what Eva's talking about, lenders' mortgage insurance. So this is insurance paid by the borrower to insure the bank should you default on the loan when you're borrowing above 80%. Now, a lot of people think that's the big boogeyman is LMI. Why would you pay $4,000, $5,000, $6,000 in or more in lenders' mortgage insurance when you get nothing in return? Well, the point being, it means that you can start sooner. And if you start sooner, and you buy the right properties in the right market cycles, the arbitrage between what you pay on lenders' mortgage insurance versus what you can get as a capital value uplift can be ridiculous. And I've seen it time and time again.
Yeah. And a lot of investors we have, pretty much all of them understand that they need to go with LMI to keep going. And so within a few years, they can get a few properties. If they wait 20% for each of those, it would take 10 years to have a few properties. And time is a big thing in investing. And the more time you have, obviously, the better. So I think really from that, I want people to get that the sooner the better. And if they don't really know how to get started, just contact us and we can give them a guide of
give them all the tricks. Well, another way to get started sooner, Eva, is just like the first property you buy probably won't be your last property. You know, you don't need to be thinking you'd be buying your dream home, that you want your forever home as your first home. Don't think that the lender that you use to buy your first home is going to be the lender that you're going to be with into the future. And you may, if you want to start sooner, yes, you may need to pay LMI, and you may not be able to access funding through a major bank at competitive pricing. You may need to pay a little more to start with to get going and get started on the assumption that you're buying well. And a lot of this is you got to be buying well. You don't want to find yourself in negative equity. That's where you buy something and then you get it revalued and it's worth less and probably less than the mortgage you have on it. That's bad when you end up there. So, but if you can start earlier by using maybe an alternative lender or maybe a second tier lender or a non-bank lender, you may pay a little bit of a premium on the interest rate. However, once you've had a number of years or a period of time where you can refinance that loan at a different LVR level, you might not be at 90 anymore, might be down to 75. It's going to open up a whole bunch of different lenders. So the point is start earlier. And every single property person I know, whether it's an owner-occupier or it's a property investor, if you say, what would you do differently if you had time again? They say, I wish I started earlier.
Yeah, I hear it all the time too.
Be that person. Be that person. And you can pay your mortgage off faster based on the type of loan that you have. And the two sort of base structures is principal and interest or interest only. Now, interest only is where you pay the interest component of the loan. So if it's for simple numbers, $1 million at a 6% interest rate, you'll be paying $60,000 a year in interest. So you're just paying that back. You're not chipping away at the value of the $1 million. However, principal and interest means that you're paying the interest component plus reducing the principal component of it. So if your repayments stay the same, it means that you pay more money on the interest, cascading or amplifying every single month, and that helps you pay the loan off faster. For a principal place of residence, a recommendation, as we mentioned beforehand, is largely to do P&I, correct?
Yeah, that's what most people would do. But we have a lot of investors that are so, I guess, caught up on their cash flow that they want everything on interest only, forgetting a little bit that their home isn't the place that will help them having a better cash flow. And that's where the debt is also non-tax deductible. And the more or the bigger that debt is, the less they can borrow. So yeah, there's a bit of sometimes confusion on why they should still pay principal on their home. But that's what you should be doing as from day one is pay the debt off if it's your home. Because then you've got 30 years to pay it off instead of maybe 25 or 20 years if you don't really refinance. And if you get off a 10 years interest only like we used to see 10 years ago, and suddenly you've got only 20 years to pay down your home, the repayments are going to be really high, really hard to get there.
So essentially you're kicking the can down the road. If you want to pay off your home, you've got to pay it off at some point. So you may as well amortize that over a longer period of time rather than getting hammered at the back end of it.
Yeah. So that simple, but that people forget about that one. That's start from day one.
Start from day one. It's just the discipline of doing it. Because I know a lot of investors who have a principal place of residence, they'll sit there and just go, but the money that I'm contributing to the principal is but a drop in the ocean of the capital value uplift I'm getting by holding onto the property. So therefore, I should use that money that I'm paying into the principal on my principal place of residence into another property, an investment property, so I can therefore get that capital growth as well. And this is the logic. But they're actually missing out on a big thing here, because if you pay down your home, let's say it was $1 million and now it's 200,000, that money that you pay down, 200,000, you could actually get it back out as a cash out investment loan, tax deductible, instead of just putting the cash within
an investment property and missing out on some tax deduction again. So they're forgetting that part, which can make a big difference as well, that you can recycle the equity in your home instead of using hard cash to invest.
Okay, so this is why you need a good mortgage broker. It's not simple. It's very,
simple.
very easy. No, it's not. It's not simple or easy.
Once you know it's simple, you just need to know why and how, and then it makes sense. And you don't want to leave money on the table. So, yeah.
And it's the reason why a lot of people tune into this podcast to sort of expand their mindset around it. And you watch property investors or people interested in property as they start learning about these things, and they have these, oh, what, really moments, which is like negative gearing, really? Is that how it works? Or what, I can use the equity I have in my home to buy investment. I can actually get that back out. Like, you get these moments where people start understanding it and then they become obsessed about it. And they're the property investors, a lot of them that tune into this particular podcast. But there's some other smart ways to pay your mortgage off faster. And what we're talking about here as property investors is, how do you pay your principal place of residence off faster so you can leverage that for other purposes into the future? Now, the simple way is to pay it off and leave it, and happy days. You don't have a mortgage on your home anymore. You don't have to do anything else. That works for a lot of people. It's more of a traditional way of doing it. However, if you start early and be smart about paying down your debt as quickly as possible, you can leverage that for wealth creation strategies outside of it. So there's another couple here to do that more effectively. We're going to go to another break. Stay with us. We'll be back to tell you all about them in a moment. Okay, how you going? It's Phil Tarrant from Smart Property Investment. I hope you're enjoying the show, chatting with Eva over at finni.com.au, Finni Mortgages, the team over there, giving us a secret sauce on how to do these things. Because you've been around this for so long, Eva, you just think everyone knows it, but it's really good to sort of check back and go through these things. And we'll ensure that we get a good article up here on smartpropertyinvestment.com.au to give people more colour or information around it. But offsets and redraws, sometimes very confusing for people that don't really get it. Please explain.
Well, they work the same way, in the sense that the more you got in withdraw or offset, the less interest you would pay each month on your mortgage, because the bank will take into consideration that money you've got in there and only calculate interest on the balance. So let's say you got a loan for 450, you've got 50K in withdraw or in offsets, your interest will be only payable on the difference, which is 400. So they work the same way in helping you paying less, but they are very different into how accessible your money is and what the bank can do with that money should you be in trouble.
Yeah, I use offsets for stuff. And property investors like offsets because it means you've got access to, you got liquidity, right? That means that you can move quickly should opportunities pop up. But the diligence is, if you have spare cash and you're not deploying that into some sort of property investment activities, you want that connected against the debt inside of your principal place of residence. Now, the important thing here, if you want to pay your mortgage off faster, is that you keep your repayments the same on your principal place of residence, the repayments as set by the bank, despite the fact that you're offsetting a lot of the interest connected to it. So what this does, if you keep topping up your offset or your redraws and you keep your repayments the same, means you're chipping away more at the principal component every single month. You're just amplifying that. And that's really, really smart. Where it doesn't work is that you really dial back the repayments that you're making on the assumption that the offset is absorbing a lot of the debt against it. So don't do that if you want to pay your mortgage off faster. That's pretty much how it works, right?
Yeah, but the issue is a lot of lenders will set your repayment as the minimum monthly owed, meaning that they don't actually, they take into consideration what you've got in offset or redraw instead of taking into consideration what would be owed if you had zero in there. So what you're saying is very true, but that's not what actually is happening. So people need to actively get into their banking app or call the bank and say, hey, I want to pay what would be owed if I had no money in there.
Yeah. So just don't assume that because the bank will go, oh, I'll keep your repayments where they are. They'll assume the fact that you're offsetting the loan. So they'll charge you the interest against what's left of that balance. So you actually got to physically call them up and say,
most banks won't do you a favor on that one. And you'll have to check.
Because banks like you paying interest.
Yes.
Yeah. So they sort of make it a little bit harder to actually pay your money back, right? They want you to pay it back as slowly as possible. Hence the reason why on a credit card, they only charge you a minimum monthly amount. They like the idea that you have this ongoing balance because they charge more interest around it. And that's it also. You can reset your repayments, sort of connected strategy with it. You can actually set your repayments with your lender as you want. There'll always be a minimum, but there's no maximum, is there? So if your repayments are $5,000 a week and say you put money in an offset, which means that you only need to pay $5,000 a month, you only pay $3,000 a month, that's what the bank will charge you. You can call out the bank and say, charge me $15,000 a month. And you're going to drive your principal down pretty quickly doing that.
Yeah, if you can, that's the way to go. The only other thing I wanted to check or talk about for offset and redraw is we had that on the news during COVID is people that had money in redraw and that lost their job or couldn't make the repayments. Bank took it, right? They took the money that was in redraw because technically that money is theirs. If you have money
hang
in
on,
offset,
explain this. So if it's in a redraw, they assume that it's been repaid, so it's harder to get it back out.
Yeah, so technically that's theirs. If you leave it in an offset, it's yours. They can't really access that. So that's really a big thing if there is risks in your financial circumstances, just to make sure you put the money where it should be. But also if the money is in your offset account, it's very accessible for you and people tend to spend a lot more of what's there.
Yeah. So a lot of people, so one of the benefits of putting into a redraw is that it's harder to get it out. So if you're not diligent or you find yourself sort of overspending on a credit card, you need to pay it off. It's hard to get that coin. However, there are restrictions around it. So, and pros and cons. You pay a little bit, mortgage products, let's talk about them really quickly. With offset and redraw facilities, they're not basic products.
Redraw basic, you get that pretty much everywhere now for free.
Okay. Offset, you do. So redraw is just assumed to be a basic feature now, is it?
It's basic. Offset are more of a package loan that cost the annual package fees, but some lenders are actually waiving that fee now, so it's actually also technically not costing you more, but it's worth it really anyway. So
got to be careful offsets also. I nearly fell into this by probably a few $100 where I was still paying the base. I think it was a P&I loan. It was a P&I loan offset with the standard P&I regular repayments coming out. And because I had it all offset, I nearly paid down the loan, which means that they would have taken it on. They would have gone, okay, well, that loan's closed. That, in order to get that money out, I would have had to refinance it rather than having it accessible. That can happen, can't it?
Yeah, technically, yes. So most banks, they wouldn't want to close your loan because it's easier, for them to have that debt there and money accessible for you to go and spend somewhere else. But technically, it could.
Yeah,
could happen.
It's happened. That's not a bad problem, really. But
no.
But if you struggle with the idea of like managing offsets and changing your repayments with banks and stuff, which will take time, energy, and effort to do that, and some admin. Another really simple way to get a similar outcome is rather than paying your repayments monthly, you pay them fortnightly, correct? Or even weekly?
Or even weekly if possible, So that will actually…
How does that work?
Yeah, so you will actually end up making full extra months of repayments every year. And again, the more often you pay your principal down, the less interest you will pay. So it sort of works in your favor by doing two things: is you're paying more often, so less interest, and you're paying one full month extra per year.
So on that basis, and you've given me an example here, so an extra $50 a week into your mortgage.
That's easy if you pay extra on top of what's the minimum due as well. Yeah.
Okay, so this is sort of saying, hey, pay more on the way through as you can.
Yeah.
So even if it's only…
instead of monthly, pay weekly. And if you can add a little bit each week, that would make a big difference. Yeah.
So $50 extra a week, which most people go, look, it's a, I don't know, I don't smoke, but it's probably a packet of lung busters or, it's a case of beer, right? Like $50 a week. Your example here on a $720,000 loan over the course of 30 years, you actually save $121,000 in interest repayments. And how much faster do you pay the loan off? That's
So
crazy.
you would pay it off quicker by 3.5 years. So instead of 30 years, it would be 20.
So you save the money and you pay it
26,
off
yeah.
faster.
Yep. Yep.
So the point is, put as much as you can. If you want to be debt free, put as much as you can into the debt as you can. And it's hard because I know people, they push hard and increase their repayments for a period of time. Then they have life changes, like, someone's out of work or they have another kid, and that sort of stuff. And people start compromising it on their mortgage. If you're going to sacrifice something, try and sacrifice the Uber Eats or potentially go to a caravan park rather than, the Four Seasons for a holidays, and pump that into your mortgage if you want to be debt free, because it does make a big impact and significant impact.
Yeah, it is the most costly debt you'll ever have. So yeah, if you have a spare $50, definitely should be in there. And to get back on the example, that's $50 a week. If you put $100 a week, then you'd save $200,000 of the life of the. How many Uber Eats would that be? Like, it's not going to happen. It's not going to happen with saving, takeaway food or whatever. So
on that basis, then you either put it in offsets, and because then it's liquid money, you can get it back out, or pay down the loan. A lot of people will think, oh, I'll put it in a savings account. I need the money for a rainy day. If you have a mortgage and you don't have an offset, or you don't put in a redraw, if you've got money in a savings account, which is much better than what it used to be, you might get 3% in a savings account today, 3.5%. You're absolutely mad. You're absolutely mad to have money in savings because it's not working for you, even if the bank will tell you otherwise. Even in the term deposit, locking up. What do you get? I don't know what you get in term deposits now, maybe 4 and a bit percent. Maybe I'm wrong there. Maybe it's 5, but still, for every dollar you have offsetting your mortgage, if you're paying 6.5% on your money in your mortgage, that means you're saving, or you're getting 6.5% on that $1.
Yep, and then it's taxed.
Yeah.
So
and you get taxed. The savings, the interest in the savings get taxed. Yeah.
Yeah. So it's definitely not worth it. The only issue, I guess, is I know psychologically people having money in the offset would go and spend it, so they actually don't pay down their mortgage as they should. So for an unoccupied debt, I'd say it's good to keep a little bit of money in the offset, maybe $10,000, and hide the rest in a redraw. Pretend it's not there, and that's really down the track will make a difference. And that's what happens where you pay extra per week, or you pay weekly, or make extra contribution. It goes in redraw. It doesn't go in the offset. It goes directly in the redraw.
Okay, so the extra money that you pay in doesn't come off the loan balance. It goes into the redraw facility.
Yeah. Yeah, extra. Yeah. Anything extra you pay is technically available for you to redraw later if you wanted to. So the money is not completely gone, right? But it is, if you have some financial trouble, technically the bank's money, and they could say, well, you know what, you haven't paid your mortgage in 6 months, but there is $20,000 there. I'm just going to take it to cover that.
And you can use these two things, to your point, in unison, where you can actually be putting money into your redraw as well as having that same loan offset. And I do that in some of my stuff as well. Excellent.
Then, it looks, I think it's achievable for most people to pay down in 20 years. I think that's
the goal. So if you have money in redraw, say if your loan balance is $1 million for simplicity, and you have $50,000 in redraw, your loan balance would be $950,000. Yeah. And that's what you're paying interest on.
Correct.
And it's good. So these are all the tricks of the trade. Banks don't like you knowing about these things, but guess what? Mortgage brokers do, because they're there to help you. Eva, that's what you do.
Yeah. So it's a bit of a structuring at the beginning and resetting, I guess, the mindset of people, or just education, really. When you don't know, you don't know. But there is ways to really, I guess, alleviate the pain of paying a mortgage. Yeah.
Yeah. Cool.
Yep.
Excellent. Yeah. Well, thanks for coming in, Eva. This sounds like pretty simple stuff for a lot of property investors, but it's a nice way for them to remind, if you're not doing it. I'm sitting here thinking, I could easily do another $50 a week. Like, really, like I go down to the Chinese joint here down in North Sydney. For my lunch, it cost me $25 for a chicken omelette, right? It's
achievable. It's basic stuff. It's basic, but I don't see it often, to be honest. Like most people, like, oh, whatever. But it could make a huge difference, over the years.
Do the banks like it when they see you having good financial management like that? Doesn't matter.
They can't stop.
Yeah.
Actually, there are some banks that would only do monthly repayments or be a bit more restrictive in the setups you can do, but they can't stop you for doing it. And lately we had a lot of 2-3 years ago, like a lot of the barefoot investors setting up accounts literally the same time, the exact same accounts with exact same repayment structures, and the bank were getting annoyed because it was like 10 transaction accounts for one person. That was a bit painful.
So from what I understand, you could have multiple. I think I saw an ad maybe it was from Macquarie. I might have that wrong. Pretty much saying you can have 10 offsets connected with one loan.
Yeah.
And the idea being is that helps you budget. You could say, kids' school fee account, you could have holiday account. So you could actually segment your money into the separate buckets, but it's all offsetting the same
account.
Which sort of is pretty cool, to be honest with you. I'd like that. Just Eva hates it.
It's a headache. Imagine refinancing that as well. I think it's a really good way for the bank to make it complicated. Okay. So it's harder for people to move. It's like, I'm not going to reset 10 accounts somewhere else and change 10 accounts worth of direct debit and my pay going in there, my wife's pay going there. It gets really complicated and people are like, oh, too hard basket.
And I imagine they would probably get a transaction fee of every one of those accounts, being a cynic.
Could be, yep. Yeah,
maybe.
Some banks do. Yeah, some banks do. It's per account. Yeah.
Yeah. I could sort of, this sort of bucket idea, for budgeting. It's not a really good budget. Maybe we can do some budgeting tips, Eva, next time around, if people aren't that good at it. But I'll tell you what, two things. If you want to make money and you buy the right properties, start investing in property sooner rather than later. And the second thing is be smart about your repayments. If you maximize, Eva's talking about good debt and bad debt, maybe we should probably do another session on that. You're talking about bad debt in your principal place of residence because you can't offset against tax, but it's good debt because it allows you to live and be happy, but pay it off as quickly as possible. That's what we're talking about. Finni.com.au is how you go and chat to the team over there. Eva, you guys are available. I know you've just done all my stuff, so you've probably got a lot of hours left in a day.
Right. Yeah, weeks. Yeah, that's good. That's good. Finni.com.au can request an appointment with a broker. And if you need just to check your situation and what you can do, we're always happy to chat. So, yeah. And
I'll just, maybe I've done this without really knowing it, but you just don't do investment property financing, right? You do principal place of residence as well. So if investors haven't looked at their principal place of residence for some time, like that's absolutely in your wheelhouse, right? You guys are experts. Yeah,
that's the easy stuff. Like it's easy if we get this. So principal place of residence, investment property, SMSF, whatever. Yeah, that's.
So anyone tuning into this can call you guys up and say, I don't think my principal place of residence loan is as good as what it could be. Can you get me a new one? You guys can sort them out for that.
Yeah, definitely.
Okay. All right. It's a good place to start because, interest isn't, you want to pay off your principal place of residence as quickly as possible. And if you're paying overs on your interest, that's just dead money. So get it sorted, get it set. And there's everyone's homework. Call up Finni, say, I want you to look at my principal place of residence, and they'll help you out. Thanks, Eva. Always good to chat.
Thank you. No, thanks for that.
Nice one. Thanks for tuning in. I'm going to get Eva to write an article for me on all of this. Obviously, she's got more important things to do, sorting out people's principal as their home loans, but we'll get an article on this because it's quite detailed, this. And I think everyone will benefit from more info on it. So go and check out smartpropertyinvestment.com.au. By the time you tune into this, it's probably up there and you can check it out. Social media, Smart Property HQ is where you'll find us. Thanks for tuning in. We'll see you again next time. We'll tell you then. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.